Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to The Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree Cathie Wood, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. Cathie Wood, the CEO of ARK Invest, has sold almost all of her Chinese holdings in recent years. She ended up selling over $40 million in Kanjun, $300 million in JD, $48 million in BYD Auto, $110 million in Pinduoduo, over $650 million in Tencent, and $165 million in Baidu. This basically reversed ARK's decision to buy Chinese stocks in February of last year. On the opposite side, many value investors are seizing the opportunity to buy. Charlie Munger, Ray Dalio, and Monish Pabrai all feel that Chinese stocks are currently trading at a significant discount. This makes us wonder which side we'd be on as investors. Well, in this video, we'll examine both sides of the discussion and make a decision about the debated Chinese stocks. Cathie would describe how we've already witnessed a valuation reset in Chinese stocks due to a few reasons in the last ARK Invest July market webinar. The underlying principle of capitalism is that productivity and innovation are formed as a result of a desire to make wealth. For Cathie, the incentive for success in China has lessened as a consequence of China's new regulations on successful companies like Didi, Ant, and Tencent. She also believes that less innovation and advancement will occur in the long run. Cathie thinks that what's happening is a reevaluation since it appears in ANT.
One thing that I think is happening is a revaluation, because it does seem, with Ant as the first example, that many, I would imagine, don't know anyone personally, but just looking at the situation, that the incentives to become, incredibly successful in China are diminishing somewhat now that the government is expressing concern.
Many people think that in addition to lowered incentives, Biden would be more merciful to China than Trump. However, the Biden government has been tough on China so far. In fact, there was a Chinese state-run media outlet recently that accused Biden of threatening war. The strict business restrictions for foreign corporations are the result of escalating tensions between the US and China. For instance, Alibaba is actively expanding its AliExpress marketplace in Europe, but this expansion may not go as planned if security issues arise. Cathie sees this as a significant hindrance to future progress.
So again, there is, in terms of these very large mega cap companies being able to scale to other parts of the world, I have a feeling there are some national security considerations that might either slow them down or stop them.
ARK selling out of China is short-term valuation concerns that'll be the last reason. Cathie Wood concentrates on long-term trends, but she also monitors and actively trades short-term trends. Because there are no short-term regulatory catalysts, Cathie believes that valuation in Chinese stocks will remain low for quite a while. So then it's possible that Cathie and ARK Invest will acquire Chinese stocks again in the future.
I would say from a valuation point of view, these stocks have come down, and again, from a valuation point of view, probably will remain down.
Cathie Wood is betting on short-term trends that stay-at-home services will continue to grow faster than anticipated. So it's feasible that she'd rather put money into this bet than invest in Chinese assets, which are expected to remain cheap in the short term. On the other hand, many value investors believe that Chinese capital markets today are quite attractive. Warren Buffett is often regarded as the greatest investor of all time because of his impressive long-term track record. However, numerous investors have contributed to the success of Berkshire Hathaway. Li Lu, known as China's Buffett, and Charlie Munger, Buffett's right-hand man, are two of those investors. Both of these experienced investors believe that Chinese assets are now undervalued. Li Lu is a successful fund manager who has generated a 20% annual return since 1998, according to multiple sources. That is really remarkable. One of the key ways he's accomplished this is by investing in international investment opportunities, especially in China. Indeed, it was Li Lu that persuaded Berkshire Hathaway to buy BYD Auto, a stock that's increased in value 59 times since Berkshire's initial investment in 2008. Charlie Munger allocated Alibaba 19% of the Daily Journal's portfolio. This was an extremely rare event, as Munger had previously only held 4 equities, with Alibaba now being his 5th. And because they're so close, speculations say Li Lu persuaded Charlie Munger to buy Alibaba shares. Munger's Alibaba investing thesis boils down to the company's fundamentals and the CCP's incentives. The Chinese Communist Party has no reason to impede Alibaba's rise in China's largest tech, so Chinese regulations affecting China's large tech are unlikely to have a significant impact on the sector's fundamentals. Munger isn't always like Buffett since he's unconcerned about what others think of him. He sees Alibaba as a developing e-commerce and cloud giant that will certainly continue to dominate. He doesn't care if people call him a sellout because he invested in Alibaba, but his Alibaba investment has risks. Munger has spoken out against the variable interest entity structure, or VIE structure, that was used by Chinese stocks to go public on the US stock exchange in order to attract foreign investors. His concerns appear to have faded down because there is no motive for China to go against the VIE structure, and any disagreement would either scare away all foreign investors, send China into a terrible recession, or literally ignite a World War III. That's pretty scary though.
There's never anything like it in the history of the world, so my hat is off to the Chinese. And I think they will continue to allow people to make money. They've learned it works. The Chinese, I loved what the guy said in the first place. I don't care whether the cat is black and white as long as it catches mice. That's my kind of talk.
In that list of the 20 most valuable companies, just 3 are Chinese. Now, if you're looking out 30 years, how many do you think will be Chinese? My guess is more, but I don't think they'll top the United States. But who knows?
Like Munger, Monish Pabrai, another well-known value investor, is extremely positive about Alibaba and has invested about 14% of his fund to the firm. Over the course of 18 years, Monish Pabrai reportedly compounded a return of 25.7% per year by not seeking firms that were just marginally discounted, but for stocks that had a huge margin of safety while still having the potential to 5 times in value. He claimed in a recent interview that Alibaba and Tencent are both solid and consistent capitalistic enterprises that would continue to develop at a rapid pace.
And especially if you look at some businesses, like, let's say, if you look at a business like Tencent, or if you look at a business like Alibaba, these 2 companies specifically, very early in their journey, had Western investors or non-Chinese investors. And both these companies, right from the beginning, I think of them more as being happen to be based in China. And because it's such a large market, happen to have most of their operations in China. But they're really, in many ways, multinational in their views and how they look at things. They've had a lot of, I would say, non-Chinese infusion into their DNA and thinking very early. And many of those elements are a big positive for them.
There are certainly compelling reasons on both sides of the discussion. Cathie Wood could be creating a short-term plan with Chinese stock valuations staying low for the time being, or she could be selling out of China because the risks are too high and future innovation will be lower than predicted. I think China's assets are undervalued from a fundamental standpoint, especially because the majority of China's businesses have stayed basically unchanged. The vice chairman of China's Securities Regulatory Commission, Fang Xinghai, reassured that China will continue to enable Chinese companies to go public in the US as long as listing conditions are followed. He went on to say that China's regulatory body had not anticipated the market's reaction to the new restrictions being so unfavorable. He claimed that in the future, China will consider market reactions while implementing new policies and will prevent extreme volatility. Maybe you're already aware that China has declared that their whole education sector would be non-profit. Despite all of the seemingly positive news, there are still some severe risks to investing in China's stocks, according to Fang, who addressed the decision to restrict for-profit education companies. For all we know, further laws might be imposed on the country's most giant corporations, and World War III or the next Cold War could occur right before our eyes. Investing in Chinese stocks could be a profitable investment move if you're fine with the risks and any ethical issues. Chinese big tech might grow in value by 2 to 5 times in the next 5 years at current valuations. And so that's it. What are your thoughts on this recent Chinese news? Will you be purchasing Chinese stocks? Comment your thoughts in the comment section below. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.